Hi, welcome back to the final part of financial underwriting. And my name is Rick Faber. I'm the co-founder of Underwriters Resource. In the first three parts, we focused on some of the basics, such as why we should perform financial underwriting. We learned our way around financial statements. We talked about credit reports, and we even learned how to calculate financial ratios. In this portion, we're going to focus on just what does that analysis tell us about the risk? How can we use that information to help us make a better informed decision? So, welcome back, and let's get on to part 4. Welcome back to the series on financial underwriting. This is part 4, the final installment of the 4-part series on financial underwriting. So you calculated all the financial ratios. Just what do they all mean? The first concept to understand is not to look at each category in a separate silo. To truly evaluate the data, one needs to consider how the ratios relate to each other. For example, liquidity ratios can be offset by healthy profit margins. Think about it. A company may not be entirely liquid, but they have a strong profit margin. Profits are being earned and can provide funding to pay bills as they come up. Likewise, a company which is leveraged with debt, but turning a healthy profit to pay interest and loans may still be in a solid financial condition. In addition, a company which is very liquid and capable of paying current bills can also take on long-term debt to lower short-term costs or finance future growth for efficiencies. The point is, just because a company may be leveraged or not making a profit or not seem liquid, other data derived from the financial statements may counter or lessen the impact of some lagging indicators. For instance, liquidity versus profit, liquidity versus debt, or profit versus debt. I can still remember when I was in college taking the required business finance class, and I could still hear the professor's words ringing in my ears when he was talking about what these financial ratios mean. To introduce the concept of benchmarking, he told an old Henny Youngman joke, and the joke goes, "How's your wife? Compared to what?" Or also there's the old saying, "A bad day on the golf course beats a good day in the office." If we're going to use financial analysis, we need to be able to compare the insured's condition with another point to determine where this particular risk stands. And there's two types of benchmarking. The first is generic benchmarking, and the second, peer comparison. When I was a young underwriter working an underwriting desk at the CNA, things were relatively simple. The standard operating procedure was to compare the risk ratios to a set of values to determine risk quality. The benchmark values were set and did not vary from one risk to another, nor did they vary from one industry to another. This points out the inherent weaknesses of using generic benchmarks. While comparing the risk ratios to a set static benchmarks gave an overall indication of financial health, it does not shed any light on the risk quality as it relates to that type of business. As I mentioned on the previous slide, using a set of generic benchmarks indicates the risk's overall financial health. However, one of the purposes of financial underwriting is to understand how a risk compares to their peers. Generic benchmarking does not shed any light on this. For example, one would not compare the financial ratios of a carpentry contractor to the financial ratios of an auto dealership. Those two businesses operate entirely different, and their ratios would vary significantly. If you want to understand how a risk is compared to their peers, you need to compare their ratios with similar types of risks. The theory is a carpentry contractor who has stronger financial strength than the average carpentry contractor is better than average. Therefore, extrapolating, they are better managed than the average carpentry contractor. Hence, they are better at managing things like safety and quality, so they are less likely to generate claim activity. This slide is a short case study of 3 Brewing companies. Well, not really three brewing companies, three sets of ratios. The first column is Kirin Brewing Company, the second column generic ratios, and the third column industry averages. Kirin Brewing is a Japanese brewer. Their financials are actually published in Japanese yen, so the ratio analysis actually took out the whole fact that it's a whole different currency out of the equation. Now, if you would compare Kirin to the generic benchmarks, one might conclude they have some liquidity issues because both of their current and quick ratios are lacking. But when you compare them to the industry averages, you get a much different picture. They're much stronger in liquidity, a little lacking on profit margin, return on equity, but they manage their debt much better than the average brewing company. So where can you go to get some of the industry data? There's a free website that I use. It's free. You don't have to download anything. It's called bizstats.com, and the URL is www.bizstats.com. You go to the landing page and you would click on corporation. That brings you to a page where they will ask you for the type of industry that you are looking at. In this case, a brewer is a manufacturer, so we would click on manufacturing. That brings us to an additional menu where you see down there is a spot called breweries, which is actually what we're going to look at. So in this case, you would click on breweries, which brings us to a page with specific brewing industry data. Now, I do want to caution the folks that are watching this video. The data that we get from BizStats or any industry compiled data, there is a lag. It's based upon tax information, and usually there's like a 3 or 4 year lag between then and now. And you want to make sure if there's a major economic variance as we're going through here in 2020, that you kind of consider that as well when you're considering the industry data. I mentioned in one of the prior videos that there could sometimes be some hesitation from clients or agents to actually get you the financial statements. And we're not really, as I mentioned earlier, we're not really looking for the entire financial statement per se. We're looking for just some data points, and specifically 9 data points. And this illustration is a list of all the data points that we need. If you're able to collect all these data points, you can perform the financial ratios. Now, I have an Excel format for that worksheet, and if you want to get a copy of that Excel format, which actually programs in the calculation of the ratios, you can email me at richard.uwresource@cox.net, and I will email it back to you. We've come to the end of the series on financial underwriting, and I just kind of want to summarize some high points of financial underwriting. First, evaluating financial strength sheds enormous light on risk quality. Ratio analysis is applicable to all sizes of risks. Ratio analysis neutralizes size. Generic benchmarking does not reveal how risks rank with their peers. Industry comparisons shed light on how risks rank with their peers. If you have any questions about the subject matter in this video, please leave them in the comments section below or email us at richard.uwresource@cox.net. Remember to like this video and subscribe to our channel. And thank you for viewing.